Hi there. Welcome back to another live stream, Lee. My name's Lee Thurburn, and it is 3 o'clock Monday, April 12th. You got to check the date. Time is flying by. Okay. Our whole purpose here on Livestream Lee is to talk about business topics that'll help you become more efficient, help you grow your business faster so that you can make more money, have more wealth at the end of the game, whenever that is, and have more time. So with that in mind, today's topic is one of my favorite topics, and I think it probably will be yours. It is how to raise the proper amount of money for your business. Now, we've actually talked about a number of things in preparation for this topic. We've talked about what your ideal market is, your ideal customer. We've talked about how to create a business plan. We've talked about how to create cash flow projections. These are all things that are critical in the process of you deciding to raise money, because you're going to have to be able to answer questions about all of this stuff when you decide to go out on the trail and start raising money. So in just a moment, we're going to dig into the fundamentals and a fairly deep dive into the process of raising capital. Before I start on that, I want to say I have been blessed in my life, my business life, to raise a little over $80 million through a combination of private placement memorandums, PPMs, and a public offering. So while I by no means am an expert or authority on the subject, I have a reasonable degree of experience, and I want to share what I've learned with you in hopes that it'll help you become better prepared to go out and do your own capital raise. Before I get started, I want to talk about a subject that's also near and dear to my heart, and I think one that you will also agree or get affinity with, and that is what you don't know is what gets you. We don't know what we don't know. None of us do. And one of the biggest challenges in life is figuring out the stuff that we don't know. Now, sometimes it comes at you slow and steady so that you can be prepared for it and figure it out. And sometimes it comes at you in a rather unexpected fashion. And those are the ones that are the big problems. There's a guy that I rely upon to help me understand the risks that are out there that might affect my business and personal life. And his name is Carlos Cantu. He is a risk management specialist, a commercial risk management specialist, though he does more than just commercial risk. Carlos is with TWFG. And I love bouncing ideas off of Carlos because he helps me think about things that I did not think about when I have an idea or somebody approaches me. Carlos is with TWFG Financial Services. He's a commercial insurance broker. And if you want to learn more about Carlos, I highly recommend that you get to know him. Go to livestreamlee.com and click on the Carlos Cantu button. There you'll be connected to Carlos. You can learn more about him. And if you decide to reach out and give him a call or ask him to call you, you'll be starting something that I know you'll be glad that you did. Carlos is a great guy, and he's really, really good at helping you think through risks that you might not otherwise have considered. And risk is a big deal. Now, I also want to invite you to go to livestreamlee.com and click on the Join My Community link. When you join the Livestream Lee community, you get an account with Apricot Rocket, which is a CRM shopping cart marketing automation tool. It's a lead generation tool. It's a business to consumer and business to business connectivity tool. In fact, if you were to think about mixing a pot with all of these things like Twitter, Facebook, LinkedIn, Constant Contact, Shopify, a little TikTok, if you put all of that stuff into one big pot and mixed it together, that's what Apricot Rocket is. It is a powerful tool, and we use it to help you get customers. If you'll take the time to create an account, and then when you do so, to profile your business, tell us about the services you offer. We get a lot of people looking for services, and we'll try to connect them to you. So go to livestreamlee.com, join the community. It's free. create the account, tell us about your business, and let us help you grow your business. All right. Last but not least, later this week on Friday, we're going to be talking to Bill Wallace. Bill is the founder of Success North Dallas, without a doubt, the preeminent, most successful, and highest level business networking group that has been in the Dallas area. And it's 25 years or thereabouts that he's been doing this. It's a great group. How Bill has built this business is going to be the subject of our conversation. Bill's a great guy. He's a servant leader, and I look forward to interviewing him on Friday, the 16th. So please join us then. All right. So let's go ahead and begin, and let's start our conversation about raising capital. I'm going to add this to the stream and do this. Here we go. And I need to be able to see it, so I'm doing that. So we're going to be talking about funding and financing your business. We're going to have a 4-part series this week, and we're going to cover a lot of really great stuff. In sequence, though, we're going to kind of build upon each day what we have learned as we go forward. Without a doubt, raising capital to launch your business is one of the most important activities that you can engage in. Entrepreneurs really do get caught in a credit crunch. There's a lot of businesses that simply don't need a lot of capital. And if you only need $50,000 or $100,000, a couple $100,000, you can find yourself in kind of a no man's land, a purgatory, where it is difficult to raise capital from professional capital sources. And by this, I mean the following. Businesses that, venture capitalists and angel investors and others, they, and banks as well, they need to lend money in decent size increments. In particular, venture capitalists need to lend money in size blocks that are large enough to be able to justify the effort that it takes for them to investigate, to do their due diligence. Many companies, venture capital type companies, when they're thinking about making an investment, they might have a block of, say, $20 million. Let's say they have $100 million to invest. In a general sense, they're going to look at about putting about 1/5 of that to work each year, which means that in a given year, if they have a total of 100 million to invest, they'll invest about 20 million. Now, they're typically going to spread that over 10 to 20 deals. So they're going to put $1 million to $2 million in each deal and spread their risk over 10 to 20 deals in a year. And then 5 years later, they're going to hope that those deals have matured and generated a return of capital and a big profit. So if they have 100 million to invest, you can expect that they'll invest about 1/5 of it on an annual basis. Now, this is a very fluid situation, and so there's no hard and fast rules on this, but what they're going to be looking at is putting all of that money to work in, again, 10 to 20 deals in the course of the year. Now, that means that if they have $20 million to invest in a given year, and they're going to do, say, 10 deals, they have to put $2 million at work in each deal. If you come to them with a small raise of only, say, $50,000 or $100,000 or $200,000, they don't want to make foolish mistakes. They want to be very careful on making sure that they put their money, which is, by the way, it's not their money. It's typically money that other investors have given them to manage. So they have to justify the decisions that they make with the money that they're in charge of. And so they have to do due diligence. And the due diligence process is time consuming and expensive. That means that when they do the due diligence on your little tiny $50,000, $200,000 deal, maybe even $500,000, they have to do the same level of due diligence that they would on a $2 million or larger deal. And so if they do your deal and they only put a couple of $100,000 at work, and they were hoping to put $2 million to work, they have to go find somewhere to put another $1.8 million. So they have to do twice as much due diligence. There's a limited amount of time and resources that every capital company has. And if you're not at a threshold where you justify them taking a look at you, you can find it actually quite difficult to get on the radar, get in the target zone of a company that is interested in investing. There's a lot of money out there. So often you'll have as much trouble not asking for not as much or not needing as much as you will. You actually have more trouble getting smaller amounts than you will larger amounts. So that's kind of the first thing to keep in mind. Now, regarding raising capital, it's important to consider the source of the capital. When you're starting to raise money, you're typically just so anxious to get money that you'll take it from almost any source. Aunt Matilda, Uncle Joe, anybody that will give you money, you'll typically be very interested in taking it from them. And it certainly doesn't hurt to have some initial capital come in to take the edge off of your anxiety about whether you're going to be able to raise the money or not. But it's also important to think about the sources of the capital and to get the right kind of money in. One of the ways to say that is there is smart money and then there's money that's not as smart. Smart money is typically connected money, money that comes from people that can help introduce you to opportunities. And so be careful about choosing, looking for money from the right kinds of investors. Money is out there. There's actually a tremendous amount of money out there. There's always money out there. There's always people that are liquid with relatively large amounts of money. Now, certainly it becomes easier in times when you have like a high stock market like we do currently, and there is harder in times when you have a tight market. There's better economic times and worse economic times. There's no doubt that that has an impact, but there's always money available. Raising that money is a full-time job. It takes a lot of time. It takes a lot of effort. You can't do it halfway, part-time. Most likely, which means it's important to get it right before you start the business. Make sure that you ask for enough money to get the business fully funded to the point where it'll sustain itself. Because if you don't get enough capital and you have to go back out and start trying to raise capital again, you're going to have a couple of things working against you. First, two are going to be wondering, well, why didn't you ask for enough the first time? And are you asking for enough now? So your credibility becomes on the line. Second, it's a full-time job running a business. And it's full-time jobs, and do them both well. One of them will suffer and the other one will do well. So you need to make sure that you ask for enough money at the same, up front. Creativity counts. There's a lot of things that you can do to bring attention to yourself and to the business. So get creative in your capital raising efforts. Do not be afraid to let your personal creativity show through. The internet provides you with a tremendous number of resources that you can access. There's crowdfunding websites, there's venture capital websites, there's angel fund websites. There's a tremendous number of places that you can go, and you can use you can not only research these opportunities to submit your business plan, but you can also use social media to find people that would be interested. Now, you do have to be careful. We'll touch later on some of the laws and some of the restrictions on how you can promote the investment that you have. There's a variety of different types of ways that you can raise capital, equity capital. Some of them come with restrictions on how you can put the word out there, so you do have to be mindful. But there's a lot of ways that you can connect with people using the internet and social media tools and various capital raising websites. You definitely need to be thoroughly prepared before you go out. You need to be able to answer pretty much any hard question that an investor would ask you. So practice your spiel. Now, no matter how much you practice with friends and family, when you get out and start answering real questions, you're going to get tripped up. And you're just going to have to go through the process of learning how to answer those questions before you get comfortable and fluid at it. It always is the case. You always get better. It's a skill that you practice and get better at. You can't overestimate the importance of the chemistry that exists between you and your investors. You want to try to do the very best that you can to make sure that you find people that have a similar perspective on life and business that you do, because it'll be a much more comfortable relationship as you go forth and start the business. And you definitely want to think about the exit. But when we start talking about exit strategies, it's important for you to realize that the only exit strategy that really, truly, genuinely will exist will be one based upon a strong, positive cash flow. If you're not able to get the company to the point where it has a strong, positive cash flow, there will not be an exit strategy. You're not going to be able to sell the company to somebody, at least not get any significant value for it, probably not get any significant amount of your investment back if you haven't achieved a strong, positive cash flow. So that is exit strategy, foundational brick number one. If you don't have that, you're not going to be successful at developing an exit strategy. Now, exit strategies really boil down into three fundamental types. One is to sell the business, and an IPO is simply to sell the business, but to do it in a public market, and that's where you get the highest valuation. It is also the least likely option that you're going to have. We're going to look at some data here in a little while, which is going to give you a perspective on how difficult it is to take a company through to an IPO, preparing it, growing it, getting the management team in place, and getting the financing sort of dominoes in place to be able to do a public offering. Extremely rare. So we'll talk about that. But that's actually the least likely option that you're going to have for an exit. Probably the most likely option is to simply not exit and just cash flow the business. And that is really probably the most common exit, if you will. Exit really means, how do I get my money back? And that's what investors are going to be concerned with. Between those two is sell your business. And selling your business to some company is a very desirable, of course, outcome. It's way more likely that you'll sell your business than it is that you'll do an IPO. And so just realize when you start talking to investors that if you start flouting or if you start suggesting that somebody like Facebook or Google is going to come and buy your business, then, or Twitter or Instagram or some other, company out there, it used to be Yahoo was mentioned, because Yahoo bought a lot of companies. If you mention those, most investors are going to immediately begin to discredit or discount the wisdom that you have, because the reality is it's very, very unlikely. It's almost moonshot level unlikely that you're going to sell your business to Google or to Facebook. Now, finding a synergistic company that's in an industry that somebody wouldn't have thought of and suggest that maybe that would be a target has credibility for you, because it shows the investor that you have a creative mind in terms of being able to think of companies that would find your new investment opportunity for them an interest a few years down the road. The most likely thing, though, is if you have a strong positive cash flow, you can simply distribute dividends or do cash distributions of some other nature to the investors that invested in your company. Once investors have received their capital back, the pressure for you to perform an exit is significantly reduced. Most investors will have a time horizon of 3 to 5 years in terms of when they'd like to see their capital returned and a big return on their investment. Now, what constitutes a big return on the investment, we'll talk about here in a few minutes. But these are basically your exit strategy. And when you talk to an investor or potential investor about your exit strategy, I strongly encourage you to focus on your commitment to developing a strong positive cash flow, and let the doors then become open. And let them know, more importantly than anything else, that you are not trying to ride this horse to the sunset. In other words, what a lot of people, especially young people, don't realize is if you have a good idea for a business, it's not the only good idea you're ever going to have. You're going to have a lot of good ideas over the course of your career. And it's a good strategy to think in terms of starting a business, getting the capital, and then giving the investors in 3 to 5 years the opportunity to get 5, 10, 50, 100 times their money back when you sell the business in some sort of exit. And then what's going to happen is you're going to have a successful business start and trend and turnover. You're going to turn their capital over, give them a huge return, and you're going to be a rock star. And they're going to be very interested in hearing from you when your next business idea comes up. Plus, you'll have a big, successful startup, take to sell, take to exit event that you can then put in your resume. And as you're starting to raise capital for other deals, you've got that to look forward to being able to leverage. So your exit strategy should be fundamentally founded on build a strong positive cash flow. Now, if your business is growing rapidly and it is a successful start, most likely you're going to need more capital than you anticipated. Businesses that are highly successful are huge cash sponges. As they're growing and as they're preparing to ramp up, they have to make huge investments in facility expansion, capability expansion, adding new people, spending money on marketing. All of these things can be horrendously costly, and they can eat through your cash. Now, you can have a successful business that's growing at a great clip, but not have enough cash to be able to fund the growth. And so when it turns out that you need to go back and ask for more cash because the business is growing rapidly, that won't typically be a hard ask to get a yes to. So what you're doing is you're then going to be raising tranches. It might be round A, round B, Series A, Series B. These don't have anything to do with SEC Regulation A. They're just tranches, and tranche is simply a French word for slice or piece. And if you use the word tranche, you'll actually sound like you know more about what you're talking about. Okay, next, let's talk about the different types of capital. Capital, there's a lot of different ways of describing capital, but for this purpose, capital comes fundamentally in 3 types: fixed, working, and growth. Fixed capital typically is related to heavy assets, buildings, heavy equipment, production line equipment, that sort of stuff. Fixed capital funding is readily available through banks. You don't typically go to equity investors for fixed capital because it's so easy to get good financing for heavy assets from banks and other financial institutions. And similarly, working capital, which is typically used to fund accounts receivable and inventory expansion, you actually also have a lot of options typically with banks, commercial banks, and other financial institutions will be resources for working capital. But growth capital is capital that is fairly risky, and it typically relates to marketing. It's the ramp up capital that you need to be able to spend money on marketing, bringing people on in advance of your marketing to be prepared for the deluge of customers that you're expecting and things like that. Growth capital is typically not something that banks are interested in, quite honestly, simply because there's no residual asset value once you've spent the money. And so typically when you have proven up your business model and you need growth capital to accelerate the growth of your business, you're pretty much left looking at investors. And investors can be a great source of patient growth capital. All right. So there are really fundamentally 2 types of capital: equity capital and debt capital. We just need to differentiate between the 2. Equity capital is the capital that you get from people that want to own a piece of your business. They give you money in exchange for them owning a piece of your business. Now, it is actually pretty risky capital. And by that I mean, Owning a piece of a startup business is a high-risk venture that only professional, experienced investors typically will engage in unless you do it through a crowdfunding vehicle. Risk capital is typically, and this equity capital, is typically going to look for a big X return on the money that they put in. They're not interested in getting a 5, 8, or 10, or even 12% return. That is lender type returns. Risk capital, high risk equity capital, is looking for 5, 10, 50, or 100 times their money back in 3 to 5 years. The reason they're willing to take a high risk of failure and loss of capital is because they're looking for a high return. So you cannot approach an equity investor with the idea of giving them a 5, 10, 15, or even 20% return on their money. They're not going to typically be interested in that. They understand they're taking a big risk, and quite honestly, the chances are extremely high that they will get none or very little of their money back because of the risk. So you need to be understanding that what motivates an equity investor is a high X return on their money, getting triple, quadruple, 5 or 10 times their money back in 3 to 5 years, hopefully 50 or 100 times. And yes, I did say 50 or 100 times. It happens, and it happens a lot more commonly than you would think. I was blessed when I started FlashNet. Our very first round investors actually received a 400x return on their money. And that is an amazing amount of money back, but it was a very high risk business. FlashNet, there were many times where it almost went out of business because we were burning through cash so fast that we didn't know where we were going to get our next payroll from. So there's high risk businesses will typically generate high returns. Okay, but it also means you're going to have to give up some equity in your business. And then there's debt capital. And debt capital is fundamentally different in the sense that it's not patient. Equity capital tends to be patient. They know they're going to have to wait 3 to 5 years to get their money back. Keep them informed in the meantime, and they're happy. But debt capital requires monthly payments. Debt capital wants an immediate return of principal and interest to begin. There are a variety of ways you can negotiate it, but bottom line is debt can be expensive because the cash flow that you need to service the debt can be a significant hamper on your operational budget. So be very careful about choosing debt capital. I highly recommend that you point yourself in the direction of equity capital if at all possible. And then, and this is the last that we'll talk about today, is hybrid capital. Hybrid capital typically is some sort of a convertible debt instrument. For instance, you might offer a $100,000 investment is a $100,000 note that you pay interest on at a decent rate of 10 or 12% for 2 or 3 years. At the end of 2 or 3 years, you give or during that 2 or 3 year time frame, you give the lender the option to convert the amount that you owe them, to convert it into stock. But it keeps them as a creditor in case you fail, which gives them priority access to the assets, whatever they are, that you've accumulated in the business. So they get to maintain the position of a creditor while they're waiting to see whether or not you make it. And then they have the option to convert the money that they've loaned you minus any, you've been paying them interest during the meantime. They convert the principal over into equity at a predetermined rate because they see that you've successfully transitioned the rough early stage of your business and that you're now stable. So you remove risk from them and you give them the ability to stay in a creditor position in the early days. That's a very attractive situation, especially in periods where it's hard to get equity capital. Regarding preferred stock is not typically something that is available to the earliest stage businesses. It is typically only something that is available to companies after they have achieved a significant size often only after they've achieved some degree of public financing, which can happen in a variety of ways, but IPOs is just one of them. There's reverse IPOs, and there are crowdfunding public placements, both of which, once you get established, a preferred stock form of hybrid capital raise would be more likely. It's not typically something that you do fresh out of the gate. Okay, so that's got us started on the subject of funding and financing the business. Tomorrow we'll take up at this point, and we'll move forward and start talking about how to approach different investors and the different investor types. I hope you've enjoyed this so far. Come back tomorrow at 3 o'clock. And before we leave, I'm going to mention a guy named Dan Nelson. I'm a big history buff. I love reading historical novels, World War II, Winston Churchill. There's a whole bunch of stuff I love reading, but I like history in general. And Dan Nelson is a genealogist that puts out a newsletter every couple of weeks. And I really look forward to his newsletter coming in because he always has something interesting that's historical. It could be great trivia. It just could be an interesting story. Dan is a researcher, storyteller. If you're at all interested in genealogical stuff, you need to get Dan's newsletter. Now, you can always unsubscribe, but it's a great read. It's a lot of fun, and you'll be like me. You'll look forward to it. Go to livestreamlee.com and click on the Dan Nelson link, the genealogy link, to get more information and subscribe to Dan's newsletter. And remember, go to livestreamlee.com and sign up to get an account. This slide deck will be available for you there. So if you want to follow along or have it as a reference point, you'll be able to get it off of the Livestream membership area. Thanks for tuning in, and we'll see you again tomorrow when we continue the broadcast. Cheers.